Hi there. This is Vikram Kaushal, and in this video what we'll be talking about some basic banking in relation to the RBI and its functions. First of all, what we'll be talking about here is the RBI's first function, and the first function of the RBI deals with the RBI's authority to issue notes. So the RBI is the only authority in India which is empowered to issue notes, with the exception of Rupee 1 notes, which are actually issued by the Finance Ministry under the signatures of the Finance Secretary. So the RBI is the sole authority in the country in respect of issuing currency notes. So the RBI is also tasked with actually printing them, and we've got the currency notes press at Nashik, and we've got the bank notes press at Dewas in Madhya Pradesh. So these two press are tasked with printing those notes, and the RBI issues them under the signatures of the governor of the RBI, who currently is Mr. D. Subbarao. So with the exception of Rupee 1 notes. Now the RBI has been authorized by the RBI Act of 1934. So the statute is actually a law, a bill passed by due procedure by the Parliament of the country or by the state legislative assembly of a state, and it becomes an act, a law, a legislation that's called a statute. So the RBI was actually empowered by the RBI Act of 1934 that it can issue currency notes up till the denomination of rupees 10,000. So the RBI, under the signatures of the governor of the RBI, is empowered to issue notes. That's the first function of the RBI. Now, talking about the second function of the RBI, we'll talk about the monetary policy. So now the Finance Ministry has got its tasks laid ahead. The Finance Ministry is tasked with the financial policy. So the chief instrument of the financial policy is the budget, which is known as the annual financial statement under Article 112 of our Constitution. But when we are talking about the RBI has its monetary policy. So the money matters, the supply of money, what we call liquidity in the market. So when we're talking about liquidity, that's the supply of money in the market, in the economy. So to control that is the task of the RBI, and that is what it does under the monetary policy. So what are the broad aims of this monetary policy when the RBI is exercising the monetary policy? What are the broad aims? Well, the broad aims are to maintain a sufficient amount of liquidity in the market, money supply in the market, so as to provide an impetus to the demand, so as to provide an impetus to the growth in our country, and at the same time maintain a balance so that the inflationary pressures do not excessively overexert themselves in the economy. So the head-on inflation and the core inflation, we want to keep them under control. So that's the major part, that's the motive behind the exercise of monetary policy by the RBI. So when we are talking about now we are talking about this monetary policy, and let us talk about how does the RBI go about in exercising its monetary policy. So the RBI has actually two kind of classification of tools that the RBI may use in order to exercise its monetary policy. And the first is we've got the quantitative tools, and secondly we've got the qualitative tools. So the quantitative tools that we talk about is the RBI exercises these quantitative tools in order to control the liquidity in the whole economy. So if the RBI is wanting to control the situation of liquidity in the whole economy in general, it is going to use the quantitative tools. Whereas if it wants to exercise its monetary policy influence in some particular sector, in a section of the economy, say for example we're talking about the agricultural sector, for example we're talking about cottage industries, or we're talking about small scale industries, or we're talking about say textile industry, or some particular sector of the economy. So what we'll be doing is we'll be exercising the qualitative tools. So we'll be making use of qualitative tools. For the whole economy, quantitative tools. For a particular section of the economy, qualitative tools. Quantitative, qualitative. quantitative for the whole economy, qualitative for particular section. In the quantitative tools, what we have is, we have the CRR, we've got the SLR, we've got the repo rate, we've got the reverse repo rate, which are counted under the liquidity adjustment facility, and then we've got the bank rate, and we've got the open market operations. So that is what we have under the quantitative tools. Discussing them first of all. Well, CRR, that is the cash reserve ratio, is a certain percentage of the total net demand and time liabilities of the bank, which it has to keep in the form of cash with the RBI. So supposedly the bank has total assets of rupees 100 crores, so the bank would be required to deposit a certain ratio of those assets with the RBI. So in this case, now that the CRR is actually 4.25%, so the bank would be required to deposit 4.25 crores with the RBI in the form of cash. If we talk about SLR, that is statutory liquidity ratio, so that it is a statute that's mandated by law. It's a statute which says that a certain amount of liquidity, so the liquid assets are gold, it's cash, and it's government bonds, government securities, what you call G-SECs, G-S-E-C-S, G-SECs, or government bonds. So the bank has to maintain a certain ratio of the total net demand and time liabilities which it has with itself in the form of liquid assets with itself. That's statutory liquidity ratio. So supposedly the bank has, say, around 100 crores of assets, so 24 crores, if the SLR is 24%, it will have to maintain 24 crore rupees with itself, against which it cannot dole out loans. So it's going to keep that amount with itself. Alright. So we've talked about the CRR and the SLR. Now we are coming over to the repo rate, and we're coming over to the reverse repo rate when we're talking about the liquidity adjustment facility. So talking about the repo rate, the repo rate is that rate of interest at which the RBI doles out loans to the other banks for a relatively shorter term. And the reverse repo rate is that rate of interest which the RBI would pay to the banks when the banks deposit their money with the RBI. So as of now, the repo rate is around 8%, and the reverse repo rate is 7%. So if a bank, a scheduled commercial bank, comes to the RBI and says that I want, say, 100 crore rupees for, say, 3 months, so the RBI is going to charge that bank according to 8% per annum, right? So now if a bank is going to deposit 100 crore rupees with the RBI and is, say, going to deposit that money for, say, around 3 months, and the reverse repo rate as of now is 7%. So the RBI is going to pay 7 crore rupees per annum. So divide that for 3 months, right? So that is the repo rate and the reverse repo rate. And then we're talking about the bank rate. So the bank rate is another one of the quantitative tools, and the bank rate is a rate of interest which is charged by the RBI as well when it gives out loans to the banks, but for a relatively longer duration. So the only difference that we're talking about when you're talking about the repo rate and the bank rate is that the repo rate is a loan given out for a relatively shorter duration, whereas for a bank rate the loan is for a relatively longer duration. And as of now, the bank rate is 9%. And then we're talking about the OMO, that is the open market operations. Well, in the open market operations, the RBI, on behalf of the Government of India, is going to sell or buy government securities, or is going to sell or buy gold. So those operations being done by the RBI on behalf of the Government of India would be called as open market operations. So these tools are classified as quantitative tools, whereas when we're talking about the qualitative tools, we'll be talking about we've got the publicity, which rests with the RBI, so the RBI can publicize, and publicity, and then it has moral suasion, that is, it says, it tells to the banks that it is your duty, it's your moral obligation that you cater to the priority sectors and you cater to those sections which have been highlighted as priority sections it's not binding by the law, but then it's a moral obligation, so it's moral suasion. And then we are talking about priority sector lending, which is called rationing of funds. So the priority sector lending, we've set under the priority sector lending norms, we've set up certain targets that at least minimum this percent of the total amount of loans that you are doling out to customers, to industrialists, to entrepreneurs, you have to dole out at least this percent of the total loans that you are sanctioning to this sector. So there are certain norms which are different for private banks and which are different for the government banks operating in India. Which are different on the basis of foreign banks and Indian banks. So these priority sector lending loans which are being doled out by the banks, out of them at least a certain percentage has to be given to those priority sector sectors defined. So differentiation is made as of now. Well, the RBI has been talking about eliminating that discrimination if we have a look at the RBI discussion papers, but as of now there is a distinction between foreign banks and between Indian banks on the matters of priority sector lending norms, which is actually 40% and 32% of the total loans. So lastly, talking about variation in margin requirements. Now these variation in margin requirements are that different rates of interests are charged when loans are given for different purposes. So if I am giving out a loan of below than 6 lakh rupees to be utilized in the agricultural sector, so I would only charge, the banks would charge 7% rate of interest, which for timely repayment would actually be even lessened, discounted by 3%. So the effective rate would be 4% for timely repayment of an agricultural loan. So where the rate of interest is low, the demand and the liquidity supply would be more, right? So by varying the margin requirements, loan margins, rates of interest, we can vary the amount of liquidity in the economy. So what we've talked about under monetary policy here is under quantitative tools, we've talked about CRR, SLR, repo rate, reverse repo rate, and the bank rate, and we've talked about the open market operations. Under the qualitative tools, what we've talked about moral suasion, we've talked about publicity, we've talked about variation in margin requirements known as priority sector lending, and we've talked about different margin requirements, that is different varying rates of interest for different sections of the liability. So well, that is the major deal of the monetary policy. So now we've discussed what are the tools actually, but now what remains to be discussed is why do we exercise these tools. So by the exercise of these tools, how is it that the liquidity, the money supply is affected? And a very important question that is many times related to this is how it actually affects inflation, the inflationary pressures in the market. How does it affect the inflation? How does it affect the demand, the supply, and the inflationary pressures? So we'll discuss that in another video soon. The effect of varying these rates and the exercise of these rates, of these tools classified into quantitative and qualitative tools. Well, thank you. This is Vikram Kaushal, and have a nice day.